So let's get started. Sean, how about a brief market overview? Tell us what's going on in the financial markets.
Yeah, so 2022 was an interesting year to say the least. Being brief isn't exactly my forte, so I'll try to be brief. I first want to go back to where we were at the end of 2021, right? The market had really been booming since the early stages of COVID in spring of 2020. The interest rates were very low, so money was cheap. The government had put a lot of money into the economy, so corporations were flush with cash, consumers had a lot of cash in their pockets. But there were some red flags going into 2022. There were a lot of supply chain issues which were causing some havoc. Inflation was becoming pretty clear. It wasn't transitory. It was baked in a little bit more. So there was some expected volatility going into 2022, but the consensus was that there was still room to grow for the market to grow in 2022. But if the past 3 years have taught us anything, the world is very unpredictable. So what actually happened in 2022 is inflation was much higher than expected, which caused the Fed to raise interest rates very aggressively, almost historically so, tightening money supply. Russia invaded Ukraine, which wreaked havoc on food and energy markets. China's zero COVID policy, they're shutting down massive cities throughout the year, causing some issues with the global economy. And we started to see the word recession kind of almost on a daily basis in the news. So that causes consumer confidence to drop. People start fleeing into, out of stocks and equities into safer investments like bonds. And the portions of the stock market that were viewed as being overvalued going into 2022 were tech and growth stocks, got hit very hard last year. But the really unique thing about last year is typically when there's a drawdown in stocks and equities, the bond market usually reacts pretty well. But with the massive increase in interest rates by the Fed caused bond interest rates to go way up, and bond interest rates and bond values act inversely from each other. So if bond interest rates go up, bond values go down. So that portion of your portfolio that was supposed to act as a cushion almost, the bond portion, got hit hard right along with equities. I actually read something interesting the other day. I don't know how interesting it is, but a little scary. The real yield on cash last year was the lowest it's been since like the Civil War era, just because of how high inflation was compared to interest rates. So not a ton of places to hide last year. And that sounds very doom and gloom, but there is light at the end of the tunnel. Inflation has stagnated the last 5 months and starting to come down. The supply chain issues and inventories are normalizing. Job market is still really strong. Wage growth was strong in 2022, which kept consumer spending resilient. So as a result of this, the market had a really strong fourth quarter, off to a good start in 2023. Do think it'll still be pretty bouncy probably this year. Maybe some stabilization in the second half. If or when there's a recession, it's expected to be a mild one just because of the strength of the job market and the amount of cash that's still out there. The Fed is expected to start slowing interest rates, hopefully stop raising in 2023, we'll see. So may still fall further, but I think the worst of the fire is probably behind us. It's not the raging inferno that it was over the summer. It's probably more smoldering at this point. But like I said, the world is unpredictable, so the key is just to keep a balanced approach and meet with your advisors. Don't make any emotional decisions, and stick to your plan.
Awesome. So as scary as 2022 might have been for some of us, there's hope on the horizon?
There's hope on the horizon. And in the grand scheme of things, yeah, it wasn't a great year, but it wasn't, kind of an end of the world year. There have been worse years.
Okay. I know I've talked to a lot of people who have said, I don't even want to look at my portfolio. I know it's down. I'm super scared to know what it's down to. And some people just want to know is it important to have a neutral third party to weigh in on stuff, especially in the light of the headlines that we see in the news? That kind of gives us a little bit of agita. Dana, what should someone be looking for in a financial advisor?
Yeah, there's a few things, and it boils down to, honestly, very simple items. If you are currently with a financial advisor, which I hope everyone in the room is, or if you've been looking for a new financial advisor, one of the most important things is just understanding their credentials. You heard when Sean and I introduced ourselves, we are fully licensed financial advisors. That's really important. And it's not that you all need to know every license available, but you do need to know who you're working with. We, as an industry, have a problem with some people call themselves wealth advisors, some people call themselves investment managers, some people call themselves financial advisors, and so on and so forth, money managers, cash managers. I mean, there's like so many names for the industry, but at the end of the day, it's really on you as the customer to understand who you're working with. That's a simple Google search. It's like out there, it's very public information, what licenses everyone holds, and you need to match up with what is important to you and what you're looking to accomplish. The second thing that I think often gets overlooked is you need to like this person. I mean, they are on the inner fold of your life. And if you don't like the person that you're working with, you are free to go find someone else. There is no reason to work with someone that makes you feel icky or makes you feel like you're unintelligent because you don't understand maybe every single term that Sean just spoke about. That's not what we're here to do as financial advisors. We're just here to help you with your goals and match those up into your future. So I do want to implore you, there's so many clients that I meet with, and they're like, I hate my financial advisor. I'm like, well, leave, like go find someone that you like and someone that you feel is really going to help you problem solve. Because majority of us have some part of our financial plan that makes us feel a little uptight, or we're not proud of, or we feel behind, or we feel ashamed, or anything. And so you really want your financial advisor to be in your corner and help you problem solve versus just make you feel worse about whatever part of this plan you're less confident about. So those are really the things that I would urge you to look at when speaking with your own financial advisor.
Awesome. That's some great advice. Thank you, Dana. When I was in college a few years ago, taking my finance class for the second time, they talked a lot about diversification. And we hear that a lot in the news. And I think with the market being what it is, there were some people that have commented, I want to diversify everything and put it in my mattress because I'm so scared. In a down financial market, it's easy to talk about diversification when things are great, but how do we deal with that in a down market, Sean?
Yeah, so just diversification is essentially the old adage of don't put all your eggs in one basket, right? The main purpose is to spread out your risk. Doesn't guarantee returns, doesn't eliminate risk completely in market downturns, but it can help mitigate risk, and depending on how you're diversified. And that becomes more important as we get closer to retirement or living in the retirement stage of our life. In the traditional investing of stocks and bonds, there's different categories or asset classes that, based on the size of the company, if they're domestic, international, different types of bonds, they all perform differently under similar market conditions. That's kind of the key, right? Similar market conditionings, all these different asset classes are performing differently. So if you're heavily concentrated in just one or two areas of the market, you're going to see potential to see higher highs, but also lower lows, right? So if you're spread out across these different asset classes, you'll still have ups and downs, but you won't be like a sailboat in the ocean during a hurricane where you're going up and down big waves. It'll be more in the middle. how you're diversified, especially in down markets, is really based on your timeline, your appetite for risk, and the purpose of the money. So diversification not only applies to investing in stocks and bonds, but utilizing different strategies and creating different goals and purposes for segments of your money. And kind of back to what Dana said about having a financial plan. Having a financial plan in place is important to help figure out, based on your individual situation, what's the best method of diversification. What are our different buckets of money or strategy, which I'll get into a little more details here in a couple minutes on strategies and buckets of money, but just being flexible, not overexposed to risk, kind of depending on your situation and your timeline. That's where having a financial advisor and meeting with your advisors on a regular basis comes into play. This is a very exciting handout. I'm sure people will rush up here afterwards for it. But I do have a what we call a skittle chart. It's different asset classes ranked from best returning to worst returning every year for the last 20 years. So and it's called a skittle chart because each asset class is a bright color. So you can kind of see every year the returns of if you just pick one and follow it, kind of the big ups and downs compared to a diversified portfolio, which is more in the middle. So hopefully I have enough for everybody.
And diversification could change from age 65 to age 70 to age 75?
Yeah, absolutely. No one's financial picture stays the same, is linear forever, right? As you grow in life, how you're diversifying also evolves with you, right? It's not just a stagnant, because this is where we are right now, this is where we're going to stay forever.
Okay, all right, super. Thank you for clarifying that. Better than my finance professor did in college. So, then I want to circle back. You were talking about the importance of a financial advisor and who to bring in. And what I heard you say, I think, is that it has to be somebody that's relational, that you can relate to, and that understands you. At what point and how do you choose whom to bring into your financial fold, whether it's an adult child or a close personal friend or family member that's going to help you, as you age?
This is really important, and it's not just important from the sense of, cognitively, like as we need maybe some extra help making decisions, but it's also the emotional support and logistics too of getting closer to end of life type of choices. So, what Beth is referring to is, at what point do we start divulging some information to either our adult children or our caregivers or our best friends that we are doing this stage of life with? Whomever these special people are in your life, at what point do we start to talk about the things that society says we shouldn't talk about, right? As financial advisors, we don't agree with that. We should talk about money all the time. The world would be better if we all shared, what we thought was best and, helped each other out. So the real answer, in our opinion, is whenever you feel comfortable and as early as possible. Whether or not that is an adult child or whomever in your life it is, the earlier is really the transfer of power and help as we age. Because at the end of the day, we don't know what tomorrow brings. And if we've been waiting for a certain amount of time to bring those people in on what our plans are financially, it could be too late, and those people are still going to deal with these decisions. So it's better for them to know what your wishes are prior to. My mom passed away 4 years ago. Prior to that, my parents were very much were the parents. You two are the children, even though my sister and I are fully grown adults, with husbands and children and everything. And certainly we respected their position, but when my mom died, it was a big undertaking for my father, and they were in a totally loving partnership type of marriage that we all strive for 53 years. They were decision-making partners for all that time. So when my mom passed away, they definitely had a financial plan, and it still took my father a while to untangle that web. Subsequently, since then, my dad has absolutely brought my sister and I more into the inner fold of financial decisions, not because he's not cognitively there. He's doing great, thank goodness. In his early 70s, his biggest problem is, oh my God, how am I going to buy yoga and play tennis at the same time? But it's more that he lost his decision-making partner. And so he just likes running things by my sister and I. We certainly don't tell him what to do with his money, but we give him the confidence to be able to make those choices on his own. And also, should something happen to him, we are way more prepared to help him through those choices. Now that's obviously on the personal side, right? And we're talking about the loss of a spouse. What if it's the loss of the adult child, right? In that vein. But those are all the kind of personal teams that you really need to build out for yourself. There's also the professional teams that you need to build out for yourself. And what I mean by that is the estate planning attorney, the CPA, and the financial advisor. As we age, those three people really need to be working on your behalf. There is no reason why they shouldn't be communicating with you about you on a somewhat regular basis. That regular basis is totally your choice. We love at Evershore to get those players in the room, either figuratively in the room or, thank goodness, for Zoom in that way, right? It does not need to be long meetings. But we can talk about you with you present. We can talk about you way quicker and leave you out of feeling like the middle person, where you're the tennis ball running back and forth between the financial advisor and the CPA, talking about things that, of course, you understand. You're all educated people, but it's not your area of expertise. Where if we could just get on a Zoom for 15 minutes, we can knock it out amongst ourselves. You're going to be standing right there, and we will fill you in on everything after, but we can really knock it out. So there's the personal team that you are going to strive to develop, and that looks different for everybody. And then also at the same time, your professional team, so that when big decisions need to be made, hopefully a long time from now, everyone is ready for them.
Awesome. I love that, Dana. My coach calls it having a board of directors, right? And so you can have a board of directors meeting of your own personal corporation and get those players talking about your financials and how to best plan. That's awesome.
Our finances are our business, right? If you run them like a business, like your coach gives the example, that's beautiful.
Yeah, absolutely. I love that. Great. Thank you. Okay, Sean, back to the market. So, as a realtor, I talk to people every day, and they're making financial decisions, and they're saying, well, what if this year is just as bad as last year in the financial market? How are we going to make sure, how am I going to protect my nest egg? How am I going to be able to be sure that that's there for me when I need it?
Yep, that's everyone, that's on most people's minds is my money gonna last for my life? And like I said a little bit, going back to diversification a little bit ago, it can be more than just the asset classes and stocks and bond portfolios. It can be important to diversify the types of investments and creating different buckets or strategies of money that serve different purposes and time horizons. And this is something we do when we do retirement planning with people. But the simplest way to look at it is you have your short-term bucket, your mid-term, and then your long-term. So your short-term is going to be designed to cover 1 to 2 years of living expenses, bills, emergencies. Is there any gap between your income, so from your Social Security or pensions, versus your living expenses? And the assets that you have to cover those gaps should be low risk, liquid, so cash, savings accounts, interest rate from bonds, dividends, income from annuities, things that aren't going to really feel much impact from a down market. And then your midterm bucket, that's going to be typically more conservative investments, kind of depending on what stage of retirement you're in. But they have room for growth, the opportunity for growth, but they're not going to feel the full impact of a down market. So investment accounts that are more bond oriented but have some stock exposure for growth, or instruments that have a guaranteed fixed rate of return for 3 to 10 years, or tools that we can use in the near to immediate future to turn on an income stream. That bucket's really there to replenish any depletion from your short-term bucket. Long-term bucket, those are for assets that you're not really going to need for your day-to-day life for 10 plus 7 to 10 years, maybe you have no intention to access at all. Those are going to be more growth oriented, so they can have some short-term volatility like this past year, but long-term potential for more growth. And also, depending on where you are, what stage of life, that'll probably be your smallest bucket of money. But the whole idea is creating and utilizing different strategies to act as a roadmap, right? So when there's a plan in place, it takes some of the guesswork out, helps create a sense of security so there's not, right, down markets, there's going to be stress. And creating these buckets of money just so they're not all necessarily going to be impacted the same by a down market. So it goes back to what I said before of different reactions in similar markets.
Thank you. Frequently when we get into a room and start talking financials, and I know this happened for me once I hit that mid-century mark, I started hearing about long-term care insurance. And the importance of it. And so, Dana, can you kind of unfold long-term care insurance? Who needs to have it? Why they need to have it? Do we all need to have it?
Let's start there. Yes. Everyone needs long-term care insurance. But let's talk about it real and describe why and why it's so important. Because it is true. All signs, all roads lead to needing long-term care. Some of us get there a little bit earlier because we've had an experience of seeing someone either have long-term care insurance and realize that, oh my goodness, I'm so thankful that they were all taken care of, right? This experience towards the end of their life was as beautiful as it could be because of long-term care. I'm going to get that too. Or others of us arrive at it from the complete opposite side, right? We see someone go through this phase of life not having long-term care insurance. We see the burden that may or may not have been passed on to those adult children or a spouse or, like a best friend or whatever, and we know that there's a different way to do things, right? So that might be some of our experience as to why we start considering long-term care. But truly, long-term care insurance is for everyone. Statistics now say that of the people over age 65, 70% will need long-term care. That is just a giant number, and it's on the rise because, thankfully, we're all living longer, right? Our life expectancy is growing, which is so beautiful, but it also means that we're going to require more care as we age. Now, of course, the research studies, they don't all match up apples to apples. So the other research studies say they all take age 50, right? I just said age 65, 70% will need long-term care. On the other side of things, the number is so much lower of age 50 and over who has long-term care. It's like in the 20%. I mean, it's so vastly different. And there's lots of reasons for that. One, nobody likes talking about end of life, right? We don't like talking about when something, that kind of debilitating cognitively, physically, whatever, when that happens, what is going to be our plan? Those aren't necessarily fun conversations. Sean and I, we put a happy spin on it that if you're taken care of, and if you've made these choices for yourself, they feel much better, right? Like the whole having a plan will allow you to feel much better about this. But at the end of the day, everyone needs long-term care insurance. The good news is that now in 2023, that looks so different from your parents or your aunts and uncles when they were considering long-term care. It was like a one-size-fits-all, and it was all really, 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 really expensive, right? And if you didn't fit into that one-size-fits-all, sorry, you're out of luck. Keep on moving. But nowadays, there are so many options. There is options to use qualified money, meaning retirement money. There are options to use cash. There are options for those people that can go through underwriting, that are healthy right now. There are options for those that maybe wouldn't get through underwriting. There are options for people that have a lump sum of money, like a larger amount of money that you would like to put towards long-term care. And there are options for people that just have a monthly type of stipend to put towards long-term care. So if you're hearing me, hopefully, long-term care is for everyone. It is a hedge against your portfolio, which portfolio is like such a strange word. It's a hedge against your money for your care later in life. There are people, and I know you know them, that you have lunch with, that you have dinner with, that whatever, that say, I'm going to personally finance my long-term care. Sounds good, right? I'm going to personally finance my long-term care. Okay, let's give an analogy to this. That is like walking into your favorite store. Think about your favorite store, whether it's Bloomingdale's, whether it's Walmart, whether it's somewhere in between, and they are running a 30% off store-wide sale. And you go up to the cash register with the things that you're going to buy, and you say, oh, no, I'm going to pay full price. Nobody would do that, right? But if you don't have long-term care insurance, that's ultimately what you're saying you're going to do. So let it not be a scary choice. Definitely have conversations with financial advisors or whomever to figure out what options you may have, because there are a lot of them out there up until the age of 75 or so. After that, it gets really tricky to be able to help someone. And certainly Sean and I and all financial advisors totally want to help people in this market, but this is another kind of thing that the earlier is better, aka cheaper, aka less of a headache, aka let's have the conversations now and not put it off any longer.
And I think that's a good point, because at some point I thought it was like 60. If you didn't get it by 60, it was too late. So that's great to know.
That's good that you think that. Go with that. Go with that.
Yeah, I need to call you because I need some of that long-term care insurance for sure. Awesome. Well, thank you for kind of dispelling the myths around long-term care insurance. Last question for the panel, and then we're going to open it up to some questions from you all. So educational partners, get ready. I'm sure we'll have a few questions. Sean, what would you say are some best practices for retirees in the market that we've been experiencing?
Yeah, so first off, it's just not even necessarily just for down markets, but it's just important to have your financial house in order. So you need to be organized and disciplined with investments, insurance, estate documents, tax strategies, bank accounts, etc. But in a down market, the big difference for retirees and those in the accumulation phases of their lives is down markets can be way more stressful for retirees. when we're still working, we can ride out down markets. We're still earning our income to cover living expenses. Hopefully we're still saving in 401k, saving accounts, rebuilding a diminishing portfolio, and reaping the benefits of compound growth in the future. While retirement stage is the opposite, right? We're no longer earning our income from work to fund our lifestyle. We're more than likely pulling out of a portfolio that's also at a loss. So psychologically, that can be a lot more stressful, and we understand the impact of that. Now that can be scary. So some best practices. First, take a thorough review of your guaranteed income versus your expenses. So review what income is coming in from Social Security, pensions, annuities, and then look at your expenses. And I don't mean, we tend to have, when we're first doing financial plans, people like to guess their expenses, which will inevitably point out that this doesn't really add up. So I don't mean just kind of assume, I think I spend this much. Take a thorough review, figure out, this is pretty close to what my expected expenses are going to be for the next year, maybe 2 years. And do we need to tighten anything up? Are there some cuts that need to be made? This is where, back to the theme of planning, since we're having a financial plan or doing a financial plan can be beneficial, even if it's just, taking a detailed look at your finances and is there anything better we can be doing? Are there some cuts that we can make? And people are creatures of habit, so I know changing some parts of your lifestyle might not be the easiest thing, but down markets could require some flexibility. And we hear people all the time say, oh, I don't have enough assets for financial plans to be wasting your time. But financial plans can be beneficial for anybody, even if it's just taking a granular look at your cash flow, right? Second step, which kind of goes back to the bucket strategy, is after you figure out what your expected living expenses are for the next year or two, see if we can have that for the short term in liquid or low risk assets, so cash, things that just aren't going to have a lot of exposure to down markets. Third step, evaluate your investments. So meet with your financial advisors to evaluate your investments, see if any changes need to be made. If you don't have a financial advisor, definitely encourage you to reach out to one or a couple. And if you do have an advisor, hopefully you're not having to reach out to them in a volatile market. They're reaching out to you. But just to make sure everything's appropriately invested, you're not overexposed to too much risk. Typically you're not going to make major changes, but are there any slight changes that need to be made? Fourth step would be for those taking income from your investment portfolios. Look at the dollar amount you came up with in steps 1 and 2 and reevaluate your withdrawal rate if necessary. It is common, not everyone does this, but it is common for people to have like a fixed percentage that they pull. So 4 to 5% off of this portfolio, that's pretty common. The problem with doing it that way is that's just automatically going to cause fluctuations in the dollar amount because your portfolio is changing up markets and down markets. So 4% off of $1 million is substantially different than 4% off of 500,000. So I would look at more of this is the dollar amount that I need, and that's also something to look at when the market's doing well, right? So just being flexible with your withdrawal rate, because if you're not flexible, it could impact you in the long run. There's a lot of research that shows being flexible with your withdrawal rate really increases the longevity of your portfolio. So that's an important step. Fifth step is just take a breath. Stressful, and we should all be aware and engaged with what our investments are doing, but don't check it 3 times a day, your accounts, and don't get caught in this short-term bubble. That's really just a lot of negativity probably if you were doing that for parts of last year. It's just going to stress you out more. So be aware of what's happening, be engaged, meet with your advisors. But like I said before, no one's financial picture stays the same forever, so you just have to be adaptable, stay engaged. Preparation, evaluation, flexibility, and a plan for different market conditions can help prevent us from making those emotional decisions that can lead to greater negative impacts in the long run. Really back to Dan's point, meet with your full team, so accountants, state attorneys, financial advisors, and that should be something that's ongoing, not just waiting for down markets.
Awesome, thank you. Those are some good tips. I like the idea of a flat fee withdrawal versus a percentage. It's really like a paycheck.
Yeah.
Right? And so it keeps your budget more in line. That's great. Well, we're going to open up the floor to some questions. And if you have a question, raise your hand and one of the partners will come to you. We want you to talk in the microphone so we can get it on the recording. And if you think you have a question, chances are somebody else in the room has the same question, so don't hesitate to ask. Anybody?
What's your feeling about annuities? You watch TV, you see one ad that says, annuity, and you see a Fisher investments, we don't sell annuities.
Totally. I can start, and then I'm sure you'll have something to add. To just broadly answer your question, annuities, think of those as like Kleenex, right? Like there's a lot of different type of tissues, right? Like not all tissues that you buy at the store are Kleenex brand, you know? So there are so many different types of annuities that accomplish entirely different goals. And so not every annuity is right for every person. But if you have a goal to guarantee income, or you have a goal to fund some long-term care insurance, right? We use annuities in a lot of different ways to accomplish a lot of the things that Sean was talking about from a diversification standpoint, from our whole topic of how to, survive retirement in a down economy. In certain applications, annuities can be extremely powerful for that. I'm sure I'm missing something, but that's...
Yeah, it's just, if you Google, I don't know, why is milk bad? You'll get 100 articles telling you why milk is bad. And then if you Google why is milk good, you'll get 100 articles telling you why milk is good. So same thing can be applied with when you see why annuities are good, why annuities are bad. It's not a one-size-fits-all. So they might not be the right solution for one person, but they could be for another, right? Like Dana said, they can be used for a variety of different things, from creating a guaranteed income, which can be important in retirement, especially for some people, or protecting assets, or going for growth. It really just depends. But sometimes, yeah, they're a really useful tool for some people, and sometimes they don't make sense.
Okay, and I think that's great. It kind of circles back to the importance of having an advisor that knows you, getting a board of directors together to see if that does make sense for your particular state.
Absolutely. Sometimes if you just keep the word annuity out of the conversation, but really listen to the goal of whatever you're trying to accomplish. If we describe it, certainly not trying to pull the wool over anybody's eyes. At the end of the day, we'll be incredibly clear what we're recommending. But if we just describe how to answer the goal and just don't say the word annuity, sometimes clients are like, yes, I definitely want to do that. And then, and then you say, okay, well, we're going to talk about this type of annuity. And then everybody, because sometimes it's like, well, wait a second, hold on. We just agreed that this totally takes care of your goal. So it's gotten that word has gotten a bad rap out there. Yeah.
Thank you.
I guess, are both of you fiduciaries?
Yeah, we act as fiduciaries.
What is a fiduciary for those of us that need a little explanation?
It just means that we are obligated by our licenses to act in your best interest when we're making recommendations. So nothing we can do can be, thinking, oh, this is better for me. It's working in your best interest. We can't have conflicts of interest, things like that.
Do you sell products?
Sorry?
Do you sell products?
Yep, so we do, investment portfolios, annuities, life insurance, long-term care insurance, that kind of thing.
Full line of everything.
Yeah.
And so to answer your question, when we are quote unquote selling a product, which we don't ever think of it as selling a product, we're just matching up what someone's needs are. But when we are doing that, you can't act as a fiduciary. A fiduciary is really just giving impartial advice, which by our licenses, we can act in a fiduciary capacity that can't be in the same conversation as we're recommending a product that someone might need. So, does that answer your question? Another word that gets a lot of buzz out there and causes a lot of confusion. Thank you for asking.
Thank you. Anybody else? Oh, got one in the back.
Most of my investments, or all my investments, are with a major investment company, and I never talk to the same person twice. So I built a relationship with many and they go with me. So I just kind of float along and see what's going on, see how much I'm losing, or escape a little bit. What is your suggestion for that?
It goes back to my answer of likability. If you don't like that scenario for yourself, you're in control. Move your money. Find someone that can establish the relationship and get to know you, get to know your money, get to know your family, get to know your choices. You're in charge of that. Evershore was created to be the antithesis of the situation that you're describing. We are not a 1-800 number. You will always get to an advisor like ours. Again, we're so not here to push Evershore at all. There are lots of firms in the area that are more similar to what we do versus the 1-800 number. But I would just encourage you that you're in control. And so if you don't like that, it's not a huge undertaking to change it. It just takes you finding the right person for you.
At age 82, is it too late to?
No,
I've been
ma'am.
in this company for a long time.
Yeah. It's never too late. Again, just if you don't like that situation, if that doesn't make you feel good about your money and your financial situation, you are totally in control, and it is definitely not too late.
But it's expensive to change, isn't it?
Not necessarily. Depends. The only expenses would be maybe if there was some kind of tax burden for changing, but outside of that, it's not like a fee for changing investments. Just always remember, it's your money, right? Just like Dana said, it's your money.
Do you have a basic amount that you start out with, or, do you take anything, a certain amount?
We don't have like a firm level, like this is our floor, but based on some of the things we do, it's not like a massive amount. Usually like 25,000 is really like we're not really useful for money for anything underneath that.
That's the important part is if you are speaking with a financial advisor and they have a minimum that is just an entirely huge number, I would encourage you to question yourself of if I want to work with that person, because again, it's your money. Your money is so important, right? It's what you have, and you should feel great about that. Our minimum is really because we're not efficient for you at that, under that dollar amount. It has nothing to do with you're not worth it to us or to any advisor. It should just be that it's not the most efficient use of your money at a certain level. Does that make sense?
Awesome. And we were talking earlier, as we were preparing for the seminar, financial services like real estate, a lot of times our answer is it depends, right? And I think that's one of the reasons why you guys are sitting behind the table is because you do care so much about the person that you're talking to and creating a plan that is perfect for them, because what fits me doesn't fit Paul and doesn't fit Nicole or you, right? So I'm really grateful for you for being here today, and they're going to be sticking around, so if you have some extra questions that you'd like to whisper in their ear, they will be available, as will all of our other educational partners. Couple of closing comments, I think. We count on you to be our connection to the world out there. So next month, on the third Wednesday. We'll be right here in this room for another great seminar, and we encourage you to bring a friend. We try to vary the topics, we vary the speakers, always providing something of interest to you. And I'll ask, did we try to sell you anything? Good, good. Glad to hear that. And we've got a quote, and I think this one is really good, given the last question. If we command our wealth, we shall be rich and free. If our wealth commands us, we are poor indeed. And that was by Edmund Burke.